Everybody. That was fun. Turns out some bagels were burning in another part of the building, and we think we've coped with it. Maybe that's a lesson for what we're about to hear about today. Sometimes alarms don't necessarily mean that they're deep-seated problems, but sometimes they do. Greetings, I'm David Levy. I'm Dean of the Duke Law School. It's a pleasure to welcome everybody here today for a discussion of the global credit crisis. What is it about the stock market and October? In October 1907, the Knickerbocker Trust Company failed and caused a panic in that year. And then October 29, 1929, Black Thursday. Then Black Monday on October 19th, 1987. October 27, 1997, we got the Asian flu that started in Thailand and worked its way around Southeast Asia and caused a meltdown in the stock market. Maybe Mr. Canning, who's here today with his reputed interest in the Chicago Cubs, can explain to us why things collapse in October. We have a very distinguished panel this afternoon to address a very important topic, important to every person, every institution, and every nation. Our moderator is Professor James D. Cox, the Brainerd Curry Professor of Law at Duke Law School. He's one of the nation's leading experts on securities law and regulation and global capital markets more generally. He frequently testifies before committees of the United States Congress. He's personally responsible for Sarbanes-Oxley, and he's in great demand both here and abroad. He was recently named to the 2009 Standing Committee of the Public Accounting Oversight Board, which is the nonprofit corporation created by Sarbanes-Oxley to oversee the auditors of public companies. Now our panelists. John Canning Jr. is chairman and co-founder of Madison Dearborn Partners. He is a 1969 graduate of Duke Law School. He has more than 25 years of experience in private equity investing. He spent the first 24 years of his career with the First Chicago Corporation, and then he founded Madison Dearborn Partners in Chicago in 1992. Madison Dearborn is now one of the most experienced and successful private equity firms in the United States. Mr. Canning is active on the boards of numerous civic organizations in Chicago, including the Children's Inner City Educational Fund, the Field Museum, and the Chicago Community Trust. He is a director and chairman of the Federal Reserve Bank of Chicago, and he's a lifetime member of the Duke Law School Board of Visitors. Stephen Schwarzman is co-founder and chair of the Blackstone Group. He is one of the world's experts on financial markets and economic opportunity. He founded Blackstone in 1985 after heading Lehman Brothers' global mergers and acquisitions team. He was a director at Lehman at the ripe old age of 31, and apparently he knew when it was time to leave as well. Blackstone is among the world's largest, best known, and closely watched investment firms. It has over $100 billion under management. Mr. Schwarzman is chair of the board of the John F. Kennedy Center for the Performing Arts, and he is a board member of numerous civic and business organizations, including the New York Public Library, the New York City Ballet, and the Asia Society. He is a member of the advisory board of the School of Economics and Management of Tsinghua University in Beijing. Most importantly, his son and daughter-in-law graduated from Duke Law School in 2006. Gao Xiqing is the vice chairman, president, and chief investment officer of the China Investment Corporation. Mr. Gao is a 1986 graduate of Duke Law School. I tell his story often in various locations, to bar groups, to alumni, as an example of how lawyers serve as leaders in the United States and elsewhere. Following graduation, Mr. Gao worked 2 years in a law firm on Wall Street. He returned in Beijing in 1988 to teach law. He has been instrumental in creating the legal structure for China's stock exchange and he later helped to create the Chinese social security system. Today, he is the general manager of China's new state investment company, making large investments with Chinese sovereign funds. Mr. Gao is loyal to his alma mater. Somehow, he has found the time over the years to do some teaching at Duke Law School, and he now serves on Duke University's Board of Trustees. Let us welcome our distinguished panel. Professor Cox, it's yours.
Thank you. I want to thank everybody for being here today, and particularly our panelists taking time out of busy lives to be here. Just to set the stage and give you some sort of context here, and also to provide a lead-in to my first question. A year ago, we would have been having a debate and discussion here about the role of sovereign wealth funds. I mean, there was a question there, these were popping on the landscape, and there was a lot of discussion across America, and particularly on the various committees on the Hill and part of the national debate. And I remember having dinner with a group of senior division heads at the SEC about a year ago, all of them thinking we needed to regulate these. And this is a burning issue. Little did we know that in a few months' time that the sovereign wealth funds of various parts of the world were going to be bailing out our banks, financial institutions, et cetera. And it shows you how that issue got quickly eclipsed by the financial meltdown that we've seen, in which storied investment banks such as Lehman Brothers have disappeared. We've lost investment banks who have now become bank holding companies. We've seen unprecedented action both in the United States and outside the action, in which when you add up the total dollars that have been committed by various governments around the world, we're quickly surpassing $4 trillion in either investments, guarantees, or otherwise in a very short order that's occurring. So we do live in interesting time and unprecedented times. And I'd like to start off with, though, first talking a little bit, since we have one of the largest in sovereign wealth funds represented here, to ask Xiqing where this debate was, where it's moved to, and what issues still you see are going forward about the role of sovereign wealth funds, and the menace that they were seen a year ago, now seeing it as a savior in today's capital markets.
Well, it is kind of difficult for us to function either way, because this time last year, true, we were regarded as being a sinister institution with ulterior motives, and people were looking at us with a lot of suspicion. Not only in this country, because in this country politics are so open and such a show that everyone has an opinion, but in Europe, very often we hear only one voice. That voice usually would be from the prime minister of some of the Western European countries. Therefore, several times last year and early this year, when we were making, just at the time when our investment committee was making a decision on a potential investment in any given country, 3 times, I think, during the meeting, we got the news that the prime minister of that country said something negative about sovereign wealth funds, especially those from China. So in the middle of the meeting, the chairman said, okay, forget it. So we stopped the meeting, and because we were deliberating on the reason why we would invest in that country. But of course now, a year after, we seem to be hearing different stories, but really it's not that different, because this is my, in my humble lawyer pessimistic view, that I keep telling our chairman that we need to do something right now, because I see the market is coming down and the people are panicking about the situation, so we probably need to make some investment to feel welcome in these places. He said, well, the price is going down further, and we don't want to catch a falling knife. I said, well, this is where they want us to do. We try to catch a falling knife, and then if we get cut, people still love us. But if the market turns up, nobody would want us. Just wait and see when people come up and say, why do we want these people? So we still have, not me personally, but as an institution, And as I read from our popular sentiment in China, all the bloggers, we still have that sort of lingering doubts there.
Well, you mentioned, and I wanted to ask John here about how this all plays out and the sort of the calamities we're dealing with here. John, how did we get here? Where are we? And what are you looking for in the future here?
You know, I saw this coming. I just forgot to act on it. You know, just two or three, probably, there are 20,000 causes, but leverage has to be right at the top, and how did we get so leveraged? In 1982, outstanding leverage was 200% of GDP. It went straight up to 365 in June, and it took that long to get there. So if it takes this long, if it takes another 18 years, 16 years to get down, it's going to be a very painful time because deleveraging just drops the price assets. So what role did private equity play in this? Our hands are clean, as Steve will tell you. In 2006 and 2007, there were 18 buyouts of $10 billion or more. Since that time, and David Rubenstein was talking about the $100 billion buyout being inevitable. I don't think there's been a $5 billion buyout since that time. And the leverage was available because the way banks got paid, and therefore the way their professionals got paid, all dealt with when do you get an M&A fee if you do a transaction. You get a commitment fee if you commit to the whole the buyout group. You get a fee for syndicating the loan, and you get a fee for packaging these loans and selling them to others. Nobody forgot in the incentive scheme, everybody forgot to pay people when they got paid off. And as a result, since the banks thought they were always going to be able to syndicate these loans, they didn't really care about covenants, about amortization, whether you paid interest in cash or not, because they were going to sell them. And going along the same track into July of 2007, subprime was coming. And when subprime came apart and syndication market stopped, it hit the buyout. The buyout syndication stopped. Banks got stuck with $400 billion of the stuff on their balance sheets, and it had nothing to do with creditworthiness of the borrowers, the subjects of the bank takeover. I mean the buyout takeovers. One other thing I think you can point to, and that is, it all looks so obvious in hindsight that the business model of an investment bank was not sustainable. In 2004, Henry Paulson led a group of investment banking people to the SEC and said, take off the rules that limit our leverage. As a result, when you had Bear Stearns, these entities were levered 30 to 1, and the problem with them is they were funding long-term illiquid assets with short-term credit. So if you take a simple example, $30 billion, $1 billion capitalized Bear Stearns, if that were what it was, but let's just say $30 billion in mortgages. If the mortgages drop 5% in value, forget not being paid, the equity was underwater and the short-term credit dried up. And as a result, there isn't an investment bank left because it was an unsustainable model, and it should have been so obvious to us all. And then the final thing I'd say is one of the biggest, and I'd say a mistake, and I don't want to say, I don't think it was politically possible not to have happened, was letting Lehman fail, because it was the first time creditors were not protected. When Bear Stearns went, when Freddie and Fannie were rescued, creditors were protected and the equity guys got creamed. As soon as creditors were not protected and they wouldn't let Lehman become a bank over that weekend, Merrill Lynch smartly sold itself. Goldman and Morgan Stanley became banks. Immediately, the buck was broken on the money market funds. AIG had to be rescued. The London interbank rate went up by 400 basis points, and banks stopped lending to each other because no one wanted to try and figure out which entity wouldn't be rescued. And so if you just take three small pieces of the puzzle, that's where I think, and now Steve has promised me he's going to tell you how we get out of it.
Well, I think that's an introduction for Steve to tell us how. But I wanted to ask you first, John. You mentioned that it would take us, I believe, 16 years probably, or you feel pretty confident that it's at least going to take, a double-digit number of years to delever, and that we're going to be looking at pretty flat asset values going forward for some time?
I do, because there are no buyers for these assets. And as a result, TARP was originally going to buy some of these. TARP is we were in the car out here, $700 billion. If you look at the credit default swap market, at one time it was $65 trillion. That's like, I don't know how many times, 90 times the TARP rescue. I mean, it was nothing. And then when they didn't use the last 350 to buy failed assets, I don't blame them, because that was a drop in the bucket. So it's going to be write-offs, it's going to be sales at pennies on the dollars, and it's going to be a very long, painful period of time.
So Steve, John's forecast that you're going to tell us how to get us out of this, but perhaps you want to tell us anything you want to amplify about how we got into the mess and where we are, and then we're anxious to hear how we're going to be saved.
How much time do you have? How you got into it really is sort of it's an easy story now that you see it, but the idea of lending money to basically poor people is the story of how this started. It was a well-intentioned, government-oriented objective, and when you lend money to people who basically don't have money to buy houses, and to show you how profound this change was, in 2002, low-income people basically were comprising about 2% of the mortgage market for buying homes. By 2006, depending upon how you measure who's poor or poorer, you had as high as 30% of all mortgages were made to people who fundamentally couldn't pay them back. Now, the statistics show it could be as low as 15% up from 7%, depending how you measure it. Now, in that kind of environment, you should expect something bad to happen, because these people can't repay the loans. And people were very clever the way they structured those loans. They'd tell somebody to borrow the money, and you didn't have to pay anything for like 2 years, or you paid very low interest before it then got reset. And through the genius of US financial engineering, they took these mortgages and put them into a security, and they sort of cut up the security in the top layer of it, the first loss, they called AAA. And these AAAs, for those of you who are not in finance, when you say until the last year that something is AAA, that just means it can virtually never default. It's almost got a religious connotation, AAA. You don't look at it. Exxon's a AAA. Nothing could, frankly, ever go wrong with Exxon. There are very few AAAs in the world. And when you call something a AAA, most people in finance don't think about it anymore. They don't analyze it because it's a AAA. If you called something on a rating scale a BBB, you have an army of analysts going over it. They don't trust the fact that it's called a BBB. They don't know whether it's going to pay off its principal and interest when due. They're very suspicious. Now, what happened to get us into this drama is that the rating agencies, for reasons that are an absolute mystery to me, figured out that if you take all of these these obligors who don't have the ability to pay back, and just to make this even more astonishing to you, in 2006, 40% of the subprime mortgages that were made had no papers. In other words, you didn't even have to fill out whether you had an income. It was like giving away toasters at bank branches or something. They're giving houses away. It's astonishing. It's absolutely astonishing. So what happened is the rating agencies came up with the theory, and it's a decent theory, that if you have a security, and if the first dollar of $100 of mortgages ought to be worth, so you ought to get your $1 back, that would be AAA. But what they did is they took it down 85%, so that the 84th dollar down in terms of credit risk was still a AAA. And what happened, of course, is it didn't end up being that way, but these securities got issued, basically they were bought by investment banking firms who then resold them all around the world. And banks all around the world bought them because they were AAA. It was like a SARS epidemic created by America, and we infected the entire world. And it took a while before the first interest payments really had to be made, or those mortgages were reset, and of course the people couldn't pay them. And then we did something else that was truly extraordinary. Exactly why we did this, I don't know. But under Sarbanes-Oxley, there's an accounting board, and they passed something called fair value accounting, which is mark-to-market accounting, which sounds like a good idea in principle, except if there's no market for something, Sarbanes and this accounting board fundamentally wants you to create a market for it. And I was talking with the heads of some investment banks. Let's pretend they had 40 billion of this nuclear waste on their balance sheet, which, by the way, to make the story even more profoundly absurd, they were selling this to other people, and they decided when they had trouble selling it to other people that they'd just keep it on their balance sheet. They'd sell some of it, but they'd keep most of it because they could get a fee and keep their earnings going. And the spread that they got for doing that was 8 basis points, okay? So that's like 8/100th of 1% profit. So we destroyed a lot of the US banking system for 8 basis points, right? Because they found out they couldn't sell this stuff. But what happened, to tell you how we really got into this, is that under the Accounting Standards Board, they passed something called Federal Accounting Standard 157, which required you to mark things to market. Inherently a good concept. But when you apply it to these CDOs, which was the names for these securities, that what happened is there wasn't much of a market. So if you owned 40 billion of them, and somebody sold 50 billion at a price, then you were sort of required by your accountants, who basically told you if you didn't do what you told them that you could be subject to criminal violations. You marked your whole 40 billion down to that marginal sale. And so what happened is that you had CDOs with very little in the way of defaults, and nobody wanted to buy this nuclear waste. So if you could sell a little of it, and you sold it at 40, then you created a loss of enormous magnitude, which, by the way, hadn't happened. I mean, there were barely any defaults when this was happening. But you read the newspaper, and you saw that the XY bank had some enormous loss, which, of course, scared people. Their stocks started dropping. The regulatory people said, well, you must raise more capital to replace these enormous losses, which, by the way, hadn't even happened. And so they found some nice sovereign wealth people in the Middle East, fundamentally, who put money up. And then there were more losses because the values of this stuff kept going down. And so even without selling it, Sarbanes mandated you take more losses. Stock went down further. And you got into this whirlpool effect of financial institutions collapsing. And as this happened, you had other pieces of bad luck. you had something called the monoline insurers, which basically guaranteed these CDOs, and they started going insolvent. The federal government decided that for $15 or $20 billion, which we now characterize as a rounding error, that they would not put the money in to save those. Now, those monoline insurers insured two things. One, CDOs, and the second is the municipal bond market. When those four basically smaller insurance companies weren't saved, then what happened is the municipal bond market went illiquid. And for those of you who serve on charity boards, university boards, usually they issue some tax-exempt securities. Sometimes they're auction preferred, sometimes they're resets. And what happened is that when that market went illiquid, people couldn't roll things over. The cost of money skyrocketed. You now had financial institutions whose entire mortgage business, not just the subprime, but regular mortgages, stopped trading. The municipal business just stopped. And at that point, you had a rolling credit crisis that worked its way through every asset class. And that's where we are today. Now, as John was saying, the interruption of Lehman was the triggering event as Lehman was basically allowed to fail. And John was completely right that the problem that we had was that when you destroy the liability structure, in other words, to make it simple for you people who aren't in finance, that financial institutions have to borrow money because they just don't lend through deposits. And they'll go out in the market and they'll buy money, in effect, and then lend it to you at a spread. They buy commercial paper. If what happens is they issue those short-term obligations, and then they go bankrupt and the government lets the liability structure get destroyed, they've in effect lent you, the financial institution, money for 3%. They've lost 100% of their principal, and you can see you don't make it up on volume. That is a bad way to spend time, a 33-year break-even. So what happens, because you can't analyze a financial institution from the outside, is that all the, in effect, people in the world who give financial institutions money all of a sudden said, as John said, I don't trust this system to give me my money back, so I'm not going to give you money, right? So had we rescued Lehman the way we rescued Bear Stearns, and there was one more, for those of you, I don't know if you have a Washington Mutual branch in this area, but WAMU, as it's used to be affectionately called, was basically handled the same as Lehman. They destroyed the liability structure, and that really just sort of ended it for any rational person, so that no one in the world really wanted to give money, and the spreads, as John said, just blew apart. LIBOR went up 400 basis points. The cost of any financial institution borrowing money, to put it in dollar terms, percentage terms for you, basically you'd have to pay 10 to 20% to borrow money and lend it at 5. And that's an opportunity to really go out of business. And so what happened is that all financial institutions said, if that's what it costs me to borrow, I'm not going to lend anybody. It's quite rational. And so they stopped lending to everyone. And that's the world that basically existed before the TARP. And when the TARP vote failed, and if I'm talking too much, seize the mic, that's absolutely fine. The TARP vote failing had consequences that were extraordinary. For people in the United States, and because Mr. Gao's here, we have a much more international group, that for people in the United States, we just looked at it as another mess, another bunch of incompetence by our government. But if you're outside the United States, you have a different view of the United States. The United States is 26% of world GDP. The United States dominates finance, and the world expects us to make things right. And as you watched the television and saw these people wandering around the House of Representatives, setting their own house on fire, the rest of the world looked at this and said, these people are out of control. They're not going to rescue us. We're all going to go down. The answer is, let's not shop. And people panicked over the entire world. And when they decided that the United States wasn't going to take care of their role, which is rescue the world's financial system, that we went on a spiral that, in effect, for those of us like John or Mr. Gao, myself, who basically live in a little world of finance, you know, sometimes we're on the front pages, but usually we're in the back pages. We just do our stuff. All of a sudden, this stuff was right on the front page of every newspaper in the world. And the fear that it struck in the hearts of regular people is also what we're dealing with now. Now, the good news is that the system that could have ended the week of September 16th and was headed to, with a complete catastrophic collapse, was basically rescued, ultimately by the passage of the TARP, not because of its usage, just because we finally did something. And more importantly, all the major governments of the world, within 2 weeks of that, coming out with a program to solve the problems that were going on. No one would lend to the banks. So what the governments of the world more or less did is they guaranteed the liability structure of the banking systems in their countries. So if you were lending money to a bank, you were basically lending money to a government. They then guaranteed the interbank lending so that banks could lend to each other so they wouldn't be scared. They then took some money and made it available and put it into banks to give them more capital. And the fourth thing that a lot of them did is got some pool of capital to buy troubled assets out of the banks to give the banks a little more liquidity. As a result of that, and you had probably about 20 countries doing that with most of the world's GDP. It was the most extraordinary coordinated action that, at least in my life, I've ever seen in finance. Extraordinary. That they basically saved the system. And as a result of that, LIBOR went from, I guess what John would say, 500 and some odd, 6%, down to 2%. The spreads for financial institutions borrowing came way in, so they could actually operate at a profit. Financial institutions were put in a position where they could function. They unfortunately have chosen not to function, which is a bit of a problem. They still weren't lending money, which people need to keep the game going, and that is exactly where we find ourselves today. I'll finish very quickly because I've taken too much time, but you actually asked the question, so I was trying to answer it like a good student. What's happening now is that people are experimenting with how to get the system rolling again. They've given the banks more capital. They need to encourage the banks to lend. Banks in June of 2007 actually weren't providing all the capital that the system was using. They only were lending about 20% of the money, and 80% was either being taken up by hedge funds who were buying loans, or what's called collateralized loan obligations, which were people, in effect, setting up several vehicles, like almost mini banks, to buy this stuff. And all of those securitized vehicles have disappeared, gone, right? So we have to recreate them, because the banking system itself, even when it restarts, will not be big enough to power the economy at the scale that we've been used to here in the United States. And that's why a week and a half ago, you saw the Treasury and the Fed come out with a series of things, including this $800 billion of securitizations, which is the first start, and they'll be doing more of that kind of stuff. You're going to see mortgages attacked through the use of Fannie and Freddie, and they drove interest rates way down on mortgages. And last week, you probably, well, if you read this stuff, mortgage originations, I guess in California, were up 200% because they restarted. You're going to have a massive stimulus program under the new administration in the United States. And you were also having stimulus of a very, very large nature being done by every country in the world, including China. Because everybody knows that the way out is you have to restart your economies, you have to give consumers confidence, you have to get the banks lending. And the reason for confidence in the long term is that since every government in the world understands that this is what they have to do, and since every government has the ability to print money, they will print as much of it as they need and do whatever they need so that their populations will have a satisfactory kind of life. And if the governments weren't doing this and weren't coordinated, we would have an unbelievable mess. I mean, compared to whatever you think's going on now, we'd be looking at something entirely different and something that could not be handled. So we're going through a very difficult period, but one of which is beyond the power of any individual business person, business organization, and we've really passed the baton over to our governments who have to do the right thing. It's an unusual place for those of us who've been raised in the capital system to ever actually be looking to the government to save the system. They do it periodically. Paul Volcker did it in, I guess, '82 with the silver crisis. And now we're doing it just on a massive scale. So that's more of me than you will ever want to hear in a recitation. So I apologize to you. But you asked how we got there. That's how we got there, where we are, and what we got to do in the future.
Steve, John was mentioning about the sort of painful process of getting over this deleveraging or getting through this deleveraging period. Do you see that as well as sort of an anchor on recovery that's going to be with us for some period of time?
Well, what's happening is that, as John was saying, the investment banking firms, for reasons that are known only to themselves and their shareholders, actually took their leverage up to 33 to 1. Banks were operating where, John, around 12? Yeah. 12 to 1. So what's happening is that everybody's trying to get these institutions down to 12 to 1. Now, if you try and do that in a 6-month period, you will technically have huge amounts of assets thrown onto the system. And there's nobody to buy all this stuff, okay? It's happening too fast. At the same time, hedge funds, which probably controlled about $10 trillion with leverage, $2 billion of equity, and no one knows how much, actually, are getting all these margin calls in effect and redemptions. So they're selling everything. So there's like a massive deleveraging going on in the system, which means individual institutions are forced to sell things either for regulatory compliance or because the, quote, market wants them to be more conservative. The system can't handle this, okay? You need to have a regulatory intervention that says, okay, if we want to get everybody down to 12 to 1 in the financial system, let's take 5 years to do it. Let's not try and do this in 6 months, along with mark-to-market accounting, right, which snaps the system. It's now called enhancing pro-cyclicality, which means it's breaking the system. You can get to the same place slowly, right? There's nothing wrong with slow. Slow is okay. Deliberate is okay. Unmanaged, which is more or less what we have going now, is not okay. And that's why you're seeing stock markets down as much as we are. You're seeing fixed income securities of healthy companies just collapsing. And people are going, well, I don't want to buy one because it's going to go down more tomorrow. And the reason it's going to go down tomorrow is just technically, if you have waves of selling and not enough money standing there to buy it, you'll have nothing but ever declining value. So somebody on a regulatory basis has to stand in the way of this and say, we just can't take this. It's too much for the system. And there will be, if you can stand any good news, usually audiences can't. They're so numbed into silence and depression. But there are going to be amazing values that come out of this. I mean, amazing stuff. You know, in the debt area, buying companies at absurdly low prices. There is, you know, in the businesses that John and I are involved with, and Mr. Gao does a little bit of it, but fortunately for him, he's all in cash right now, pretty much, except, you know, the poor luck of buying some of our stock, which went down a lot, along with all the other financials, right? Same thing. But the values that will be created as a result of the technical selling, it's just really technical. Some of it, there'll be troubles, but a lot of it are healthy companies, just you're throwing the baby out with the bathwater, that we will make enormous amounts of money out of this, you know, as long as you are careful analytically. So there'll be some great times here. But you know, this whole systemic management really needs coordination, and we're now operating on a global basis. No one country has the ability to do this completely right themselves. You gotta have everybody in the world coordinating on a regular basis so the deleveraging doesn't happen too quickly. Is that more than that's sort of right? Go for that one?
Yeah, Xiqing, you have the longest perspective on this because you're from seeing it from Asia.
Would really like, with all respect, I would really like to take issues with Steve on two particular points. I know Steve has been very vocal about his criticism of this fair accounting method. So, you know, we say mark-to-the-market system. As I have the baggage of being a former regulator and also former lawyer, and I've been working on the securities market issues for more than 20 years. And my respected professor, Jim, sits here, and knowing that I've been very vocal in China about these things. And mark-to-market was one of the things. Personally, I don't have a problem with mark-to-market itself or not mark-to-market. The problem really is, as a former lawyer would say, predictability. You know, in the market, once you have something, this is like in accounting, you have the FIFO, you have the LIFO. You know, either way, you just have to be consistent. If you've been doing the same thing for the past 20 years, 30 years, then people learn to get to know the system. So people learn how to evaluate things, given or take all the, you know, the things in the middle. The problem today is that you have already had the mark-to-market for so long, especially in the United States. You know, the European countries take a sort of different approach, and not only the regulators, but also the companies. Therefore, for us, as you know, standing outside in China, when we try to make most of our investment in these countries, we still believe, and this, I talk to many sovereign wealth funds, I talk to many of my colleagues in the various countries, we still believe that the United States is by far the best market to invest in. Why? Just for this one particular reason. Because it's a lot more transparent, a lot more predictable. But once you change the rule, like Steve was suggesting, then we will have problems. Because it takes a long time for us to readjust to the new system, for us to try to figure out, because by definition, people would have a lot more room to maneuver, the executives in the companies. Because it takes longer time for them to finally come out with the, you know, where they're at. Because if you don't mark to the market, then, you know, at some point you just have to, people have to evaluate you. So how do they do it? You're based on either on historical cost, or you're based on replacement value. You're based on these things, that these things are really, you know, these are things that are bygones. These are things that happened a year ago, 2 years ago. With the changing situation today, it's very difficult for people to, and you know, unless you are actually a corporate insider, very difficult to do it. That's why when we've been approached by European governments many times, and they say, "Oh, please come to us. Look at the Americans. They're all in a mess. Please invest in our country." Most of my colleagues in the front office look at the companies, and they always say, "Well, in the end, we still think American companies look much cleaner." And we have a lot more confidence, even though many of the companies' value has come down so much, we still feel that it's a lot easier to understand. This is one issue. Second issue really is with sorry about this, Steve, about your, this is really not you, but a lot of people saying that the American government made a mistake in not bailing out Lehman. That could be a mistake. I'm not commenting on that specific historical event because, in 30 years' time, people are going to comment on it. But to me, most of these things are just the result rather than the root of the problem. Steve gave a very good, very comprehensive explanation of how we got into this. But without the few links there, I think the basic problem is that basically I'm saying here, Americans have been spending other people's money or your own future's money for too long. You can possibly spend $1.50 when you are making $1. If you think you are going to make that dollar back, that 50 cents back, tomorrow or the day after tomorrow, you can do that to some stretched period of time, but you can't do it forever. You've been doing that for about almost 30 years. At the time when I started studying law in China, I started the Chinese law school in 1978. 1980, that was the time when we studied economics, the American physical debt to GDP was 20%. And at the time, we already thought it was too big compared to China. And last year, about 120%. And people still think, well, we can probably do more. Why people think that? Because we need the money. We need $700 billion to bail out all the banks. We need $800 billion to bail out other things. We need probably another $1 trillion for all the real economy. So where does that money come from? From the fact that the United States, as of today, is still the most powerful country in the world. And because of the whole system after the Second World War, you're still able to print money, and people buy it. And recently, when we were pointing it out, he said, look, someone told me to the face right away, said, look, people in history have been betting against the American dollars, betting against Americans, and every time they bet, they lost. That's probably true in history, but will that still be true in the future for the next 100 years? I'm not sure about it. And when we look at the dollar movement for the past few months' time, people say, look, dollar is going strong again. See, because everything is in relative terms. When dollars are going down, other people's money are going down too. The euros, the pounds, and all these things. That's probably true for the present time. There are technical reasons for the hedge funds, settlement, all these things. The problem is that if you go on with that, if everyone does that, of course, then people will still go to the relative quality, which is, this is the strongest country in the world, and has a very, very dynamic society, very industrious people here. But the problem is that this is not only country that does that anymore. You have a lot of countries coming up with more willingness to work and with less willingness to spend. And, I'm not talking about China where you have almost 50% of savings rate. Look at Japan, look at India, look at all the Middle Eastern countries, which many of American government people don't like. You look at them, they save the money to make it possible for Americans to be able to spend for tomorrow's money or other people's money. That is not going to last forever, especially after this crisis. When people look at it, this time when we got phone calls from Hank Paulson, from the Fed, from people telling us, okay, please don't move your money around. Please just keep your money there. Please buy more of American Treasury bonds. We say, yes, we know. We know that because if we do that, we hurt ourselves. But there's a big but. Because now we see that we did ourselves in by purchasing mostly American Treasury. We are willing to finance your economy if you are treated fairly. I won't even say nicely. But the problem is, I have a lot of very specific examples that we're right now having issues with the Treasury, with the American government. But that's beside the point. I'm not going to point it out. But the thing is that if you want to do that, this is when I was asked to give advice to the new government, I say, well, at least you want to be nice to the people you borrow money from, because if you keep saying, like what I read recently from several noted economists or people telling us that the true reason of your financial problem was China, because the Chinese have been jacking up our prices and doing all having our foreign currency, having all the savings, so that we provide too much liquidity for this country. That created a problem here. Well, if you say that, then that same thing can be said to many other countries, and people eventually start to realize that maybe we can't do that anymore. So gradually, we're slowly moving money out to diversify the money at least. Which, by the way, when I was pressured by American government officials to move our money out, I said, look, we're just following the rules set up by your organization, by the IMF for all these years. Every year we have a meeting with the IMF who would come in, check, and really supervise over our policy cross board with all financial institutions. Say, okay, you need to set up your risk control organizations. You need to set up your policies. You need to be really very cautious about your things. We're being cautious. When we look at a situation, when we look at all these AAA institutions, which are rated higher than our government, and we say, well, maybe there's a problem. Let's move the money out of the more dangerous waters. Then we're told not to move it. So eventually, things will change. I'm not saying for the immediate future, for the next 6 months or 12 months or even 18 months, things might look good. But what about in the long run? We are, as a sovereign wealth fund, we're looking at 5, 10, 20-year horizon. And I don't think, too many people would die in that sort of time horizon sitting here. So we would have to look at things longer. If we don't resolve problems like that, that's sort of hot air in this huge balloon, if you don't let it go, one way or the other. I agree with Steve that you have to let it go slowly, but you have to let it go. That's the most important thing. You can't say, okay, let's inject money, let's print more money, and make the balloon hot. For whom? For your next generation, for your next president. But it has to come down, because you can't do that forever, because for one country you can do it, because you can use other people's money. But now everyone knows it. So what if we don't provide the fuel for you to warm up to the hot air? Then you have a problem. Sorry for the long-winded.
So John, I wanted to ask you some questions about risk management, but Xiqing raised a very good question about who's going to buy all this paper that's going to be issued, and then we have to borrow money. I mean, what do you see happening there? I mean, we're talking clearly $1 trillion or plus here in the very near term. Where is that going to be sold, and who's going to own it?
Well, I was just at the meeting of the chairs of all of the Fed district banks, 12, and the co-chairs or the deputy chairs, and the governors down in Washington. And since the lending programs, the 20 lending programs with all kinds of acronyms, have since the first one that they started, which was 4 or 5 months ago, their outstanding credit on those balance sheets is increased by $1.2 billion. Now, they can keep printing money, so you can keep doing that. I don't know, and so far it doesn't appear to have worked. I think one thing that has happened is we've taken the systemic risk out of banking. Basically because, and back on Lehman, I agree that I don't think it was possible not to let Lehman fail, because they would have had to try and convince people about the disaster that was going to occur. And eventually, someone had to fail. So that we have Lehman fail, it's had a lot of consequences, and we're dealing with those consequences now, but it is the result. It isn't the cause of those consequences. And mark-to-market accounting, I know you're a big advocate of mark-to-market accounting. Everybody that's failed has blamed mark-to-market accounting, and that to me is kind of like, arguing, again, they argue they should do away with mark-to-market accounting. And in those cases, I think it's like arguing you should do away with your police department because they keep catching you driving drunk. What really mark-to-market accounting exposed in a Lehman was the fact that they were leveraging themselves 33 to 1 and buying very risky, illiquid assets. There are places where mark-to-market accounting makes no sense at all. And Volcker gave an he spoke at dinner last night, he gave an interesting example. He said, you have a local banker who makes a loan to the guy who's run the hardware store forever. And he's hoping to get some of the family's business, and he's hoping to get deposits, and he's hoping to get some other, maybe some trust account business, so he makes him a 6.5% loan, fixed loan. Now, and he says, now, as soon as he puts that loan on the books, if his accountant walks in and says, well, who's going to buy that loan? Try and sell that loan. He's not going to be able to sell it for what he put it on the books. So if that's how you had to live, you wouldn't make any loans. So there is a place where mark-to-market accounting just discourages, and it's not even risk-taking. It's putting, let's just take an example that if you had somebody following your credit score hourly, and they said, we want to see your assets, liabilities hourly, you wouldn't go buy a new car because when you drive it out of the lot, it's a used car. So you wouldn't buy it because your credit rating would go down. So there has to be some recognition, and it's as Steve says, you don't go to these things overnight. I mean, my God, that was the killer. And as most of these assets have dropped in value, some of them have dropped in value below what they're receiving in payments. They haven't defaulted, but there is no market.
One of the culprits here has been risk management. John, what do you think are the lessons we've learned for financial institutions managing or not managing the risk, and how are we going to improve upon this process going forward?
Well, incentives were all in the wrong places. Earnings were reported on the basis of putting business on the books, syndicating loans, taking risks, and as I said before, no one got paid when the loan was corrected. As a result, risk managers sometimes were embedded in the department. Sometimes they were reporting to the people they were controlling the risk of. They were never as well paid. They were never incentivized. They were never rewarded for constraining growth. And there was a culture, not only in the ones that have failed, but there was generally a culture of if you want to keep your job, you are not going to blow the whistle when it apparently looks like good business. So I would say in most cases it's a cultural issue. And I think that's coming to the fore now. We've also learned that, everybody says, well, if you put your own money in the game, if you had investment, you'd be more careful. Well, 35% of Bear Stearns was owned by the employees. But I think what happens is they had a mentality of playing with the house's money. They were paid in stock. They were given bonuses in stock. They were given options. And it was kind of the house's money. They didn't have to reach in their pocket and say, I'm putting some real money in this thing. So risk managers will now be very senior people in institutions. And the Goldmans of the world are going to be very stodgy institutions going forward. They're going to be banks. They're going to have trust departments. They're going to make loans that make sense, that have covenants, that actually are reasonable spread loans. They're not going to be able to leverage themselves like they did, and it'll be like Morgan Stanley originally was founded.
Well, on that point, are we ever going to see, or do we want to see, higher risk levels outside of commercial banks? I mean, you're mentioning sort of the standard metric is 12 to 1, I believe you were mentioning, and is there room in our financial markets to go back to something higher than 12 to 1 outside the standard bank sort of model?
Well, remember, and one of the most amazing things about the standard bank model, and the government's done a good job of this, is banking exists, it's a myth. If everybody showed up today to get their money, they wouldn't get it. So the reason the model works is everybody believes that their deposits are insured by the government to the now 250 level, and they don't have to worry about showing up. And without that trust in that part, that's why Goldman and Morgan Stanley and the Lehman weekend became banks, and that's why everybody else wants to become a bank. In the old days, nobody wanted to be a bank. We're not a bank now. So I think the answer to your question is there is no room for more increased risk. And the reason you can have as high as 12 to 1 is that you couldn't have even 12 to 1 in this environment unless deposits were guaranteed and unless people believed they were guaranteed. We got into a very dangerous weekend when Indy Mac went bust and its deposits were guaranteed and people were lined around the bank trying to get their money. But we had a very fortunate weekend when WAMU went bust and people did not make a run on the bank. And they believed they were going to get their money out, which, you know, they weren't. So banking is going to be a very stodgy, reasonable return business, I think.
What about outside, Steve? What about outside of the banking business, the private equity? Are they going to have a stomach and a wherewithal to take on greater risk in the future?
Well, you don't need greater risk with low prices to make huge amounts of money.
Okay.
And you can run a system at 12 to 1 without any trouble. That's a fine way to go. I'd say that I'd agree with Mr. Gao that global imbalances, which is what he was really describing, can't be sustained forever. You can't have everyone in the world financing our addiction to spending. It doesn't work. You can't have Social Security systems in the United States that can't pay their obligations. You can't have Medicare that can't fund itself. I mean, there are certain things which edge into domestic politics that actually just involve numbers. And you can't have a global system where everyone has to be bailing us out all the time and we remain the reserve currency of the world. So I agree with Mr. Gao, obviously, on that. I'd say with this fair value accounting, just to put a bullet in it, so it doesn't, it's boring to everybody except those of us who are practitioners, actually. In 1975, the U.S. banking system was insolvent. There was a real estate collapse. And I want to contrast that with what's happened in this situation where the banking system was insolvent. 1975, you didn't mark loans to market. If you made a loan and you were at a bank, you expected it to be repaid. You kept it on your books at its cost, unless you thought that loan was impaired. And what happened in that crisis is, first of all, they didn't announce it as a crisis. The second thing is that the Federal Reserve basically talked to the banks and said, you know, this insolvency is like a bad thing. So what we want you to do is not charge your loans off. We're going to lower interest rates. We're going to create a bigger spread for you. You don't have to lower what you charge to customers. And we want to give you 3 years to charge your loans off, and let's keep it a secret, just between you, the banks, and the Federal Reserve System. We'll keep it a secret, and let's just get through this thing. What happened is that worked just fine. I want to compare that to our current system. Current system is, you make a loan, loan's going to get paid off. In your view, all that matters is where somebody might buy that loan. So that loan, instead of being at its cost, is now down around 70 cents. Okay? And this is what John was talking about with Paul Volcker, because it's not serving the benefits of the system. Instead of taking 3 years to charge off the problems of our system, which we did in the mid-70s, we're doing it mark-to-market every day. We are driving, the system into a level of stress it can't take. Now, I realize this is like, I'm like a religious heretic, right? Because this is a belief system that, in fact, this is all theoretically good to be doing. But if it breaks your system, it's not good, okay? So there needs to be a way of bridging this so that we can stay as a viable society economically. I am not against transparency. I think transparency is like a great thing. Nothing wrong with transparency. But if you force leveraged institutions generally into instantaneous, huge write-offs, with the consequences being their instability, that doesn't serve the purposes of a society, nor does it serve the purposes of the international system. So in that, I don't know whether we're disagreeing or agreeing on that, but I know that a certain amount of control by the government to deal with these issues is a very useful thing for having the rest of us just lead our lives in a normal way with normal markets. So I hand that over to you, Mr. Gao, yes, to tell me whatever you would like.
For years, since I got back to China 20 years ago, for the first 10 years, I always found myself on the defending side of American policies, philosophy, culture, the people, and everything. And then the previous 8 years, more or less, have become very difficult for me, more and more. And more and more I found myself, having to defend them, but with great difficulties. Now, all of a sudden, I found myself defending American philosophy against my American friend. Basically, I agree with you on a lot of technical issues, but this is a fundamental problem. Why? Because when we compare the American system with our system, which we call, the Chinese, we call it market economy with Chinese characteristics. Now we have a planned economy here. What I've been saying, sorry, but what I've been saying is that this system, in fact, it's not really American system, it's the overall capitalist system, have been based on one particular thing in human nature. We say human nature is basically bad. I'm oversimplifying it. But in our case, all know the Mencius teaching. This is the biggest disciple of Confucius who said, at the beginning of time, human nature is all good. My professor, John Arcus there, teaching us all these things. So our systems, as of today, still tries to tell people, or tries to predicate everything on the belief that people are basically good. But that doesn't work with the capitalist system. That doesn't work with our market economy. So now, all the rules that we talk about, the rule of law, is basically predicating that, well, okay, people are going to make mistakes. People are going to take advantage of the system if we don't discipline them. The reason why we had fair accounting system, I think, was exactly because of that. I agree with Steve that if we give people enough time, 3 years, 5 years, gradually let things out, then things can work out better. But you're talking about two different evils. Another evil is that, the one evil is the fair accounting now. We say if we mark down the price right away, because most of the companies now, we're talking about all listed companies, the market price is going up and down with confidence issues, with all sort of idiosyncrasies. With that, you have a problem of really, truly fairly evaluating it. You are factoring in a lot of different things. That's all the noises. But at least you have a basic signal, which is what we would call the basic value of the company. the noises revolve around the basic value. But here, you have a accounting system that says, okay, you can do it yourself, based on the good conscience of the corporate executives, do it in 3 years' time. Over the long run, that would still move around this basic value, but with a much larger wave. Once you allow people to move in that bigger tunnel, then chances are people, if they can, they always try to get to the side of the tunnel that's more benefit to them rather than to other people, rather than to the small investors. That's my problem. As I'm probably overly pessimistic in that regard, but as a regulator, I've been seeing things like that, especially in our economy, in China, in our market. And we've been trying so hard to copy American securities law into our system. We've been trying so hard to advocate these things, but I'm the arch enemy of a lot of the regulators in China today. They keep telling me, look, this is all you're doing all these years. You've been trying to learn from Americans. Look at them. Now they're coming back our way. So we should allow people to just sort of maneuver within the system. I still have a problem with that. Because you may have a lot of good people like Steve and John, but you have bad people as well. It doesn't take too many people like that to ruin the system. I just don't want that to happen. That's why I have a fundamental problem with that. I think it is if you with all the inadequacies of fair accounting, it takes more regulatory issues really. If you can regulate it well, then you can do it better. But if, by the same token, if you don't do that, you do the old 1975 accounting rule. If you have a very good regulatory system, then you can do that as well. But the problem is, again, people in this country don't believe in the ability or the willingness or the incentives of the government agency, of the regulators. They say, well, those people are probably not going to do their job. Why don't we just keep it the other way? Let people do it themselves. That's why I said, no, I seem to be defending the ultimate capitalist principles.
John, I want to shift gears here and talk about something that's even closer to your backyard, and that's private equity. What do you see as the future of private equity? I mean, Steve mentioned there's going to be lots of chances for buying. Most of us associate private equity with a fairly heavy tranche of debt that goes along with it. But what can you say about the future of private equity?
First of all, when in the 2006-2007, when these 18 buyouts, $10 billion each, I think the peak purchase price was 9.3 averaging, and leverage was over 6 times, and that's probably even understated. Those days are gone forever. Not just. So living off leverage is not the model going forward. As a matter of fact, what we see primarily now is growth equity opportunities because no one has capital but private equity, guys. When you really look at it, there's no IPO market. There is no other source of capital but private equity. As a result, we have decided, and it's very difficult to decide how you should price your equity when you have no clear view of the economy, and so it's very difficult to plan an exit and say, when I exit, the earnings will be X and the multiple will be Y, because no one has a clear view of when this will all turn around or end. But having said that, there are still people that have good businesses that need capital, and we wouldn't use leverage. We have increased the cost of our capital by, and it's even hard to say because we've only done one transaction, but I would say at least 500 to 1,000 basis points. And I mean, it has to be, getting a deal through our shop right now is not a pleasant experience. It has to be perfect. It has to be perfect. You know, we had an interesting transaction, a household name in building products of all things, came to us and has it's a big market share company, came to us and trying to avoid a refinancing issue, but not really a bankruptcy issue. And it came to us and said, we need an investment in the form of senior debt. We'll pay some interest on it. We'll give you blank % of the company. And our return could have been 40% annualized if the stock just got back to September 30 level. And we didn't do the deal because we couldn't convince ourselves that the company could survive 5 years. And that's what we had to convince ourselves, that the financing would have it survive 5 years. And everybody who has predicted the turnaround in housing has nothing beyond 212. But I don't believe it. I mean, I don't disbelieve it, but I sure as hell don't want to put money into something believing it.
Steve?
I think that when you have this level of uncertainty, and we have like funny little words in finance, we have a concept of catching a falling knife, which is when you try and guess the bottom of something. And catching a falling knife usually severs the tendons in your hand. And all young people try and invest that way because they think they're smart enough to figure it out. Those of us who are older
and have severed tendons,
right? And you know, with good microsurgeons, we've learned that that's not perhaps so wise. So at this stage of the economy, what you look for are non-cyclical bets. Now, the reason John and I haven't coordinated anything, as you could probably well tell before we were up here, but the reason he walked from that is that that's a violent cyclical housing. And ultimately, it's not prudent to buy a violent cyclical just because it's cheap. It could get cheaper. But if you buy a non-cyclical, okay, and we actually just did a deal. That was shocking. Shocks almost everyone we know. And this is a company that is the largest supplier of oxygen to people who are at home and are sick. Now, I sort of believe this is non-cyclical because my basic belief is that most people do want to breathe. And if you give up breathing, that's a problem. And we bought this company at 4 times cash flow, okay, 4 times EBITDA. For those who understand what EBITDA is, a pre-tax cash flow measure. So in effect, what we're getting before capital expenditures, which in this company are very low, like a 25% cash-on-cash return. Now, I don't know what the Duke Endowment just lost in the last year or 4 months. I read that Harvard's down 22% without measuring its private equity, its foreign emerging market stuff. Harvard was probably down 30%. Now imagine, we're going to get like 25% a year for people who have to breathe. And this type of company in a normal environment is worth about 8 times cash flow. And we could borrow, we actually did better than this, but just make the math easy for you. We borrowed 2 times cash flow and put in 2 times cash flow, roughly. So if it goes to 4 times, it goes from 4 times for the whole company to 8 times, we make 3 times our money, and we've done nothing, right? Just allowed a recovery in the markets to occur, but not a recovery with this company. The company just keeps making the same basic kind of thing. In the meanwhile, it's paying down its debt because it's making surplus money. So that's probably 1 more time. So we'll make 4 times our money on this company without improving it. And of course, like eager little beavers, we've got some kind of improvements that we want to do to it. So we'll make 4 to 5 times our money with this investment with people who have to breathe. Now, private equity can do amazingly well. And in fact, if you go to the consultants, there's a little industry of people who study us. And then they go to institutions like Duke and say, you should invest with these people or you should invest with that. And they even go to CIC and do the same thing. Now, the biggest returns for private equity happen to be when there's the least amount of debt available to borrow and the least amount of debt put on a company. It's totally counterintuitive for people who read newspapers and the financial press and listen to the town criers on CNBC, right? And it happens every time there is a recession. And what happens is in recessions, people get scared, just like this kind of discussion. People are scared. And what they do when they're scared is they sell assets and they don't want to buy assets. And as a result of that, assets tend to plunge in value. And then if you're people like John, or people like myself in our organizations, just like John ran from the one that was the cyclical, he'll find one that is non-cyclical, just like we happened just by accident to run into this one, because we all live off of accidents. And you'll buy things like this, and when the world recovers, which it will, you'll make a fortune. And all the consulting studies show that the transactions done at this time when, as you asked the question, how can private equity do well? The returns are double to triple in the first 2 years of a recession of things you buy, as opposed to things you buy when things are really good and everybody's happy and your endowment's gone up, sort of 15, 20% a year for 3 years, and people are writing articles, the economy's good, and private equity guys are giving interviews about how they're going to do $100 billion deals or something, and that's when it's not a good investment. So you actually just have to understand that model to realize that this is a terrific time, actually, to be putting money out, as long as you're not catching a falling knife.
Well, Steve points out that people need to breathe, and so do wines. And I've been told that the wines have been breathing for a while, and now's an appropriate time for us to go sample them, but not after thanking our panel here of 3 great speakers who have really, I think, left us with a fair amount of hope, frankly. Thank you very much.